This is video 7 of IAS 20. We're going to look at low interest rate loans, forgivable loans, as well as government assistance. Now we are quickly going to look at low interest loans. These are loans that are below market interests that you receive from the government. So this is a government grant. So why is this a government grant? Because in the market you would have paid 10%, but now you pay 5%. So you received a benefit. Therefore, it is a government grant. What amount are we going to determine for this grant? The amount is the difference between the proceeds received and the initial carrying amount under IFRS 9. You guys know how to calculate the fair value of these loans. You guys have done it before. So we are going to focus on the government grant. So we calculate the amount of the grant and we're going to use that amount and account for it in terms of IAS 20. Then the loan is still accounted for in accordance with IFRS 9. This video is not going to deal with the loan. We are just focusing on the IAS 20 part, which is the government grant. Then, very importantly, you still need to determine whether it's an income or an asset-based grant. If this is a low-interest loan to buy an asset, this is a monetary asset-based grant because now you're paying fewer interest. This makes this a monetary grant. If this low interest rate loan that you received was to pay for training for your staff, then it is an income-based grant. And remember, like we've said, the manner in which you receive the loan does not change the accounting treatment. So let us look at an example. Ironman Limited received a loan of 1 million rand from the government on 1 July 20x12. The loan is repayable in 5 equal annual installments of 230,000 rand from 30 June 20x13. The loan carries interest at 5% per annum, while a market-related interest at similar loans is currently 15%. Interest is payable annually in arrears. So can you guys see that there is a benefit? The market is 15%. We only pay 5%. Therefore, this is a government grant. Very importantly, in this scenario, we are not yet aware of whether this is an income or an asset-based grant. We still need more information. And then they also tell you Ironman Limited has a 30 June reporting period. As we said, IAS 20 tells us that the benefit of the below market rate of interest shall be measured at the difference between the initial carrying value of the loan determined in terms of IFRS 9 and the proceeds received. Like we said, we're not focusing on the loan. We are focusing on the grant. So you determine your fair value by discounting your payments over 5 years at a market-related interest, which is very important. Use the 15% to calculate your IFRS 9 fair value. Then you compare that to the proceeds of the 1 million that you received, and you get your amount for the grant, which is the 225,000. Okay. So now you have your amount for the grant. Go look at the rest of the example for the journals under each type of grant. What are forgivable loans? The definition in paragraph 7 tells us it's where the lender undertakes to waive repayment under certain conditions that are prescribed. Okay, so you received a loan from the government and now you don't have to pay it back. Therefore, there is a grant. It is treated only as a government grant when there is reasonable assurance that the entity will meet the terms. Very important. Then the same as with low interest rate loans, you still need to determine whether it is an income or an asset-based grant. Thor Limited is a cellular services provider and has a 30 June reporting date. A R1 million loan from the government was received on 1 July on condition that the company constructs a cellular tower in a rural area. The loan was granted on market-related terms and is repayable after 5 years. The cellular tower has been completed 30 September 2012. Just from reading that paragraph, we can see that there is no grant because everything happened in market-related terms. Then if we read on 1 October 2013, 1 year later, the government informed Thor Limited that if the company constructs a cellular tower in another rural area, the company will not have to repay the R1 million loan. Here is where the grant comes in, because now you don't have to repay the loan. And the loan was conditioned that a cellular tower be constructed. Therefore, it's asset-based. And because it is a reduction in a loan, so now we don't have to pay the loan back, it's a monetary loan because it has to do with money. Then the second cellular tower was completed 31 December 2013 at a cost of 2 million and was immediately available for use as management intended. The cellular tower has an expected useful life of 40 years and is depreciated on a straight line basis without taking into account the residual value. And that 40 years is what we use for our paragraph 12 systematic basis. Assume that there was reasonable certainty on 1 October that the conditions for the loan to be forgiven will be met, so we can recognize it on that date. Now, what do we know? We know this is a monetary asset-based grant, so we know there are two methods that we can use to present this grant, either decrease the cost of the asset or recognize a deferred income. So what you guys can do, you can look at the rest of the example at the solution. It's exactly the same as we've done the whole time with each type of grant. So we've done everything on this slide. Now we just have to go and look at government assistance. So what is this government assistance? I've already told you guys that there's a difference in government assistance and government grants. Okay, government assistance is only disclosed, while the grant is recognized and disclosed. So what is the definition of government assistance? A government assistance is where the government transfers economic benefits to a specific entity or a range of entities with specific criteria attached to it. And it also has exclusions, but it does not include benefits provided indirectly that affect general trading conditions. So it's not specifically for the entity, it's just general. For example, the infrastructure is repaired, or there are constraints put on your creditors. So it is advantage to you, but it is excluded from government assistance. Just as a summary, what is the difference between government grants and government assistance? Grants are a form of government assistance. Assistance is where actions are taken and there's no transfer of resources. Where with grants, as we've learned, it is a transfer of resources to the entity, where assistance is just actions taken. IAS 20 also tells us that grants are accounted for and disclosed, and assistance is just disclosed. The only thing left to do now is just to show you guys which disclosures you have to study. So with disclosures, you have to know the disclosure for grants as well as assistance, and you need to refer to paragraph 39. Disclosure is self-study, and you have a lot of examples that you can go and look at. So here is just a summary of what we've done, and we've looked at all of these components of the standard. Okay, so the first thing you need to do is identify whether you have a grant. If you have a grant, you need to decide whether it's an asset or an income-based grant. If it is an asset-based grant, you further have to identify whether it's a monetary or a non-monetary grant. Then it doesn't matter if you have an asset or an income-based grant, both of them have to be amortized on a systematic basis in terms of paragraph 12 to profit and loss. So we've dealt with everything in terms of IAS 20, and you guys can look at your handouts for questions and solutions.